Okay, thank you once again for attending today's presentation. Hopefully you've already viewed my presentation 1 of 3 in this series. Today we're going to be continuing on Chapter 9, Managing Your Investments. Please take a second to read the famous quote up on the screen, and then we'll jump into the presentation. So today we're going to focus our attention on 1031 exchanges and combining that with a Delaware statutory trust. So if you are a real estate investor, this could be an excellent tool for you to use if you're concerned about selling your investment property and incurring a huge tax bill. So I'm going to go through the details of how this strategy would work, but I want to let you also know that a DST is what we call a private placement. So this is only available to accredited investors. If you don't meet the definition of an accredited investor, unfortunately, you're not going to be able to utilize this strategy, but we're providing this to you strictly for educational purposes only. So what is a 1031 exchange? The Internal Revenue Code, Section 1031, was specifically written so that if a real estate investor wants to sell a business or investment property, they could sell that property and exchange it for another business or investment property without getting the burden of paying taxes on it. When this was originally created, this code section, there were farmers that were living, let's say in Montana, and they've been farming there for 20 years. They wanted to relocate to another state, but they were not able to do it because if they did it, they would end up incurring a huge tax liability and losing a significant amount of their net worth. So the government said, let's find a strategy where you could exchange one investment or business property for another, and that was what gave the birth to the concept of a 1031 exchange. So specifically, you could exchange like-kind property in the deferral process. And when we refer to like-kind property, what we're talking about is investment or business property for other investment or business property. When I talk about business property, we're still talking about real estate that you're using in your business. For example, if you're a dentist and you own your own dental building, your dental office, that would be considered a business asset, which is part of your real estate. You could then sell that property, do a 1031 exchange, and buy another investment property. Like kind does not mean you have to buy the same type of real estate, so you could exchange a raw piece of land, a vacant piece of land, for a multifamily house. You could exchange a multifamily house for a self-storage facility, for a retail space. You could do any one of those combinations. What you can't use a 1031 exchange with is your personal residence. So if the real estate is used for personal use, 1031 exchange rules do not apply. All right, so that pretty much defines what like-kind property is and the basics of a 1031 exchange. So from an estate tax planning point of view, you're going to get tax deferral, and that tax deferral will eventually be tax-free income to your beneficiaries. So what do I mean by that? Well, again, let's assume you sold the building for $1 million. You originally paid $100,000. You took depreciation on that property. And let's assume the full $1 million is now subject to tax. You're going to pay tax on that. Chances are you're going to lose a good 35% of that, depending on what state you live in. Not a good investment decision. By doing a 1031 exchange, you could exchange that property for another investment property and defer paying the tax on that. If you continue to hold that property until your death, upon your death, your beneficiaries will get a step up in basis. That's a step up in basis to the fair market value of that property as of your date of death or 6 months later, whichever works to your advantage. So utilizing a 1031 exchange, the specific rules here are as follows. The date you sell the property and go to closing, that is called the relinquished property. That's day one. You relinquished the property, you went to closing. That money, critically important, cannot touch your hands and it cannot go into the bank account of your lawyer. That money has to be held by a qualified intermediary. I'll explain that to you a little later. Once that property has gone to closing, you have 45 days to notify your qualified intermediary of what your intention is, what property are you going to buy. Now, when you identify that property, I always encourage my clients, identify at least 3 properties. In the event that the original property we're going to buy doesn't go through for some reason, you still have choice 2, you still have choice number 3. Leave yourself with options. So within 45 days, you have to specify what you believe your replacement property is going to be. And then within 180 days from when you originally sold the first property, you have to close and complete the purchase of the new property. If you don't meet these strict time deadlines, then all bets are off and you're not going to be able to complete a 1031 exchange. Many people have completed 1031 exchanges in the past, myself included, where we sold one investment property for another investment property. But truthfully, for many people, they don't want the headache anymore of managing a property. Well, there is another alternative out there where you could do a 1031 exchange and purchase a replacement property, but that replacement property could be held through what's called a Delaware Statutory Trust, a DST. So, looking at the slide here, you can maximize your after-tax cash flow utilizing a 1031 exchange with your investment or business real estate utilizing a Delaware Statutory Trust. So, in order to qualify for this, as I mentioned earlier, you need to be an accredited investor. What this means is you have to have a financial net worth, not counting your personal residence, of $1 million or more. Or the other alternative is, as an individual, you have to have at least $200,000 of income every year for the last several years. Or if you're married with the spouse, you have to have at least $300,000 a year. If you meet any one of these criteria, then by law, you could get involved with private placements, and that's what a DST is. If you don't meet that criteria, then unfortunately, this tax saving strategy would not apply to you. So, what exactly is a DST? Well, a DST stands for Delaware Statutory Trust. This was a law that was created through the state of Delaware. Regardless of the fact that it's a Delaware Statutory Trust, it's universal, so you could use it anywhere throughout the United States. There's no restrictions with that. But this is a partial ownership interest in a much larger real estate development. So just to read what's on this slide here, a Delaware Statutory Trust permits fractional ownership interest where multiple investors can share ownership in a single property or a portfolio of properties which qualify as replacement properties under the 1031 exchange laws. So until a private letter ruling came out allowing this, investors were not allowed to do this. But according to the IRS, they permit it as long as we meet the strict requirements that are set up with every Delaware statutory trust. So what are the key benefits of using a 1031 exchange along with the DST? So up on the screen here, I'm going to cover each of these with you right now. Number one, you end up having no management responsibilities. It also gives you access to institutional quality properties. DSTs are, in fact, limited liability protection is provided. So whether you have an LLC or not to hold your real estate, you really don't need one if you have a DST because you get the same limited liability protection. You have low minimum investment thresholds. You get the benefit of diversification. And as an investor, you understand the importance of diversification. The estate tax planning benefits are the same as I just mentioned. Tax deferral will become complete legal tax avoidance, not just for you on the capital gain, but also for your beneficiaries. It also acts as an insurance policy. And what I mean by that, let's assume you were going to buy a property that you were going to manage, and you listed that as one of your 3 choices. Well, as a backup, in case that property doesn't go through, let's say there's an environmental issue or you don't qualify for the mortgage and you thought you would, then as a fail-safe, you should identify 1 or 2 DSTs because if the property you were originally going to buy on your own to manage doesn't work out for any reason, then the insurance policy here is you're not going to pay the tax. You can now put the money into the DST that you identified with your intermediary. And the strategy that many people use, once you're involved with the DST, I think it's more than 90% of DST investors, they implement a swap until you drop strategy. What that means is that once that DST property, whatever property is held within that DST, when the sponsors say this is the time to sell the property, and they make that decision now and they sell the property, you have a choice. Choice number one, you're going to pay the tax on all the money that you get from the sale of the DST. Choice number two, you could do another 1031 exchange into a physical property that you're going to manage on your own. Or the most popular choice that's done more than 90% of the time, people will then do another DST. So you'll do a 1031 exchange out of the DST you previously owned into a new DST, and you'll continue to do that every time the property is sold until you pass away. That's where the drop comes in that phrase. So that concludes my presentation on 1031 exchanges and DSTs. Hope you found that helpful.